Welcome to the Move IQ podcast and the First Home Focus series. We're sharing advice and guidance on how to get that first rung on the ladder. And of course, one important part of the process is that vital financial planning and budgeting. So in this episode, I'm joined by Andy from Skipton Building Society to help break things down. Andy, fees are quite a daunting prospect when you've not been through this whole process before. So can we just talk a bit about the upfront fees that people should expect when applying for a mortgage, buying a house?
So you're right, it can be daunting, but I think the key thing is just understanding what fees are there and what's expected. So the typical fees a first home buyer would come across would be a mortgage application fee, would be also a fee that's added to or can be added to the product itself, can be also paid up front. Valuation fees, solicitors fees, stamp duty is another one that they need to be aware of, but being first home buyers, they may be eligible for some leeway, let's put it like that, but I'd always suggest go online, check on the stamp duty calculator to see the purchase price that they're buying at, would they be liable for a fee?
The mortgage application fees, they vary quite enormously across different lenders, don't they?
They can, yeah.
Is it, I mean, a fee's a fee.
Yeah.
But if you can put it onto the mortgage, is it something that people give great relevance to or not so much?
I think they need to be a little bit careful here on how we say this, because there's two options here. Yes, they can add it to the fee, add it to the application, should I say, but they end up paying that fee and interest on it over the full term of the mortgage.
Yes.
So yes, it may make things more affordable, but they need to be cautious as it may not be the best option for them. So this is where I'd always say, go and speak to a professional, get some professional advice if they're unsure what to do. And
what mortgage related fees should first time buyers expect?
So again, it's they'll have a mortgage product fee potentially, valuation fee, a CHAPS transfer fee, which is quite minimal, but still a fee. And then obviously solicitors fees. There are some products which have free valuations, but again, it's got to be the right product for them. For the sake of saving a couple of £100 for a valuation, it may have an impact on the actual product they get.
Is it always true that the larger deposit you have, the better deal you'll get? Is it as simple as that or not really?
I wish it was, but if I'm being honest, it probably isn't. It depends on the actual applicant. Yes, in summary, the more deposit you can put down, the lower the rate is, but there's other factors that play a role in this. So things like the actual mortgage product fee. So it may be the case you get a really low interest rate, but a really high fee, which does that make that the cheapest overall, the best deal for them?
It's quite hard to analyse that one, isn't it?
It is. And I think this is why they need to go and speak to somebody to get advice on this. It's important they do, because the initial headline rate may not be the best option for them. Yeah. And it doesn't necessarily mean that lender is the best option for that client as well.
If someone is being gifted money towards their deposit, is that relevant?
Yes, obviously, if they're struggling to save for a deposit, they can get a gift. Lenders do consider this in a different way. So the usual rule of thumb is if it's part of the Family Law Act, so mum, dad, uncle, first cousin, etc., then they will tend to accept a gift quite happily. Yeah. Okay.
And in situations where people are struggling to get that deposit, what other options are out there?
So at the moment, there's two other low-cost options for low-cost deposits. Obviously, you can speak to different lenders about this. The other, to flip the coin on this, is if they're struggling for it and can only get, let's say, a 5% deposit, there are other options such as joint borrower sole proprietor or income boosters, where they can actually increase their affordability if they are struggling to get to the amount they need.
And remind me, so an income booster is where there are other people on the application? So
yeah. Absolutely. So they can add somebody on that will not be on the deeds, but will help them with affordability to get to the level they want to borrow.
And so that person is essentially on the hook if the main owner of the property defaults.
Yeah, definitely. I mean, even though they're not on the deeds, they're still liable for that mortgage. Yeah. But again, the definition of this varies from lender to lender. Okay. So I'd always say get the right advice, go and see somebody that can explain this in more detail.
And what about some of the other government schemes, the lifetime ISA? Are you a fan of those?
Always a fan of something that could help first-time buyers. So the more options that are out there, if anything, there's not enough options out there. But I'd always say is go and do your research. As you said, there's LISAs, ISAs, lots of competition for different rates out there, so worth kind of digging into.
Do buyers need to be wary of insurance? And indeed, what kind of insurance do lenders want to see in place?
So from a lender's point of view, to be able to complete, they need to make sure the house is insurable. So they need buildings insurance. That's the key component for this. It needs to be ready and in place by completion. Solicitors will confirm this, if not a little bit earlier, if I'm being honest. But that's the main insurance that needs to be there. From a personal point of view, you're moving into your home, you want to stay in there. The best option I would recommend is, and I say recommend loosely, but definitely discuss it with somebody about protection. So life insurance, critical illness cover.
Again, that all needs to be in place before completion.
Yeah.
So you can do it after exchange, but it needs to be in place before completion.
The key one that needs to be in place is building insurance. The rest is optional, but I would always say have the discussion.
And what about when somebody's actually completed, they're now living in it?
Yep.
Ongoing costs of doing that aside from actually your monthly mortgage?
So obviously, as you said, monthly mortgage is something that's new. It's going to be there, part of the monthly payment, but the usual bills that will come up are going to be your council tax, utility bills, water, gas, electrics. I'd always suggest, because it's a new process and a new commitment from the buyer that's moved into the property, is try and have, as we call it, I suppose, a rainy day fund, at least 3 to 6 months worth of payments put aside. Appreciate it may not be as easy as you say when you put a deposit. Exactly. But it's something that you've got to work towards, because if the worst was to happen, you've got to ask your question, how could I stay in my home?
Yeah. Any other particular tips just to finish off with on how people should plan for this?
Be diligent. Is a key thing. Of look at and review your bank statements, see what you're actually spending on. Is there opportunity before you go outside of home? Look internally to see, can you save anywhere? Are you spending a bit too much or more than you should be? And from that point is always check your credit report. Obviously go online, have a look. There's free options out there, but it's good to know where you stand.
So it's about planning and preparation, and also being forewarned. Forewarned is forearmed, isn't it?
Exactly that. Yeah, very well said. Yeah.
Good to talk to you, Andy.
Good to talk to you, Phil. Thank you.
Thanks for joining us on this episode of Move IQ's First Home Focus podcast. We hope you found our tips and advice helpful. And remember, home ownership may be closer than you think, and we are here to support you every step of the way. So please don't forget to subscribe, rate and review our podcast so you never miss an episode. Until next time.